so often when we invest, we don't think about the underlying cost and impact. Now, what is the cost of investing? These are fees incurred by investors to buy, sell, and own stocks or mutual funds. And the illusion is, well, if I don't see it, it's not really going to hurt me that bad. But there are underlying impacts to cost in your investment portfolio that you may not be aware of, in anything from your 401k to the Roth IRA that you opened just in time before you filed your taxes. So with that, let's just look first at what happens when we search this on Google. If you Google, in quotes, real cost of mutual funds, you will find the top article is an article from Forbes. Now, it may seem kind of funny to you that the latest article that ranks at the top of the Google search is an article written back in 2011. But one of the first things to notice is if you flip through Forbes, Inc., Entrepreneur, Money Magazine, Smart Money Magazine, any of these, it's astounding how many of the full page color ads are actually from mutual fund companies. In fact, you go to the website for any of these Google results, and a tremendous amount of the advertising and the banners on the right, left, top, center, pop-ups are from where? They're from financial institutions offering to manage your money. As a result, these financial publications don't have a lot of interest in consistently sharing with you how expensive all of these platforms are. It's as if a car magazine continued to write articles about how a particular luxury brand had just been screwing up every car that came off the line and had all these incidental repairs and things that you shouldn't have to worry about. Well, that would cut off that entire luxury brand from advertising in Car and Driver. So you'll notice that they don't do things very often, any magazine, that attacks or does a significant disservice to those who would advertise with them. So if you get a chance to look at this article, I'm going to give you a glimpse of it. We just kind of took the top of the article, the bottom, and fit it on a slide. But you can Google the real cost of owning mutual funds, and you'll actually find this article is the top result. Now, what they did in the article, which I thought boiled it down so simply, is they took the expense ratio, which is the thing that most people are familiar with. In this particular case, they came up with an average expense of 0.9%. So 0.9 of 1% for a set of actively managed equity-based mutual funds, but then they disclose some other costs. Some we're going to share with you more about here in a minute, but there's a cost called transaction cost. Transaction cost is the trading of the underlying stocks inside of a portfolio. Now, for years, and by the way, I'm not the only one who had this experience, for years, I always assumed that the mutual fund company paid for all their research and for all of their trading and everything out of that asset management fee that's disclosed. In this case, a little less than 1%, 0.90. Now, that is not the case at all. Our returns from a mutual fund are paid to us out of the net proceeds of every trade. So these asset managers are trading stocks inside the fund, and every time they do that, we get the net proceeds of that trade. But out of that trading, there's brokerage commissions and fees that have to be paid, sometimes to an associated entity with the mutual funds and sometimes to an outside party. But the thing to consider is that there's just a huge chunk of cost that's not disclosed. On average, as a result of this study, it was 1.44%. So we have a 0.9 disclosed cost, then an additional 1.44% of transaction costs. Let me give you one more look inside transaction costs. Would be if that asset manager had to sell $10 million of, say, Microsoft, but after the trading is done, they net less than $10 million. For the sake of this conversation, I'm just going to say they net $9,995,000. Well, that's all that's reported to the mutual fund, but that extra chunk of money that had to go to the trading costs is a real cost. It's just not reported in the asset management fee. In fact, this is such a prevalent misbelief. Even in the advisor community, I had a gentleman I spoke to who'd been in the industry for 30 plus years. And I shared that with him. And he said, I'm fine with all the stuff you do, and I appreciate some of the training you do for our advisors, etc. But at the end of the day, I think you're just fear mongering. That stuff isn't true. There isn't really all that extra cost in the mutual funds. And I said, I don't want to be disagreeable, but you're flatly wrong. I said, what do you mean I'm flatly wrong? I even, after watching your presentation, because we had done a group setting presentation, I went to unnamed mutual fund company, talked to somebody on the phone and said, is there any additional trading costs? And they said, no. I said, what you need to do is ask for a few managers up and they will give you the right answer. He says, I just don't believe it. So I said, well, which is your favorite one of their mutual funds? And he told me. I said, do you have a prospectus there? He said, yes. Now, I'm sometimes known as the Control F King, meaning hit Control F or Command F if you're a Mac user and quickly find stuff in a PDF document or a web page. So I quickly pulled up that prospectus on my end via PDF. He and I are chatting by phone. And I said, just turn to page, I think it was 14. I said, you see right there, it says trading costs are not reflected in the expense ratio. And it gave him pause. And he said, okay, I'm going to call them. And he did. And he went, asked for the managers like I had mentioned he should. And sure enough, they didn't report it inside the mutual fund the way he vehemently believed for over 3 decades. Now, here's the thing. When he was done with that, he has millions and millions and millions of dollars under management with this mutual fund company. Was he able to pivot and change his ways immediately? The cost isn't that big and their performance is okay anyway. It's valid. It's not what I would have done, but that's what's happening across the mutual fund marketplace and in the financial services industry. People are used to doing it the way they're doing it, and they don't acknowledge those costs. Now, there's one last cost that's reflected here on this slide and in that article, and that is something called cash drag. You see, most mutual funds are purchased not with any kind of rigor, but they're sold by the investment advisory community, bought by clients who oftentimes do not have the best behavior when markets are volatile. Because of that other investor behavior, and when you invest in one of these mutual funds, picture yourself like locking arms with a whole bunch of people your left and right that you're depending on them also, because you're in a mutual fund with them. All of you and your closest 150,000 friends have plopped your money into a mutual fund together and you're counting on their behavior. Well, what kind of bad behavior would hurt your returns? Well, the first off is they know these people are more likely to have higher redemptions. Because they know they're going to have redemptions when markets are volatile, they keep a lot of money in cash. And it produces an additional drag on return in this study of about 0.83%. Now, that's not counting the tax cost if this is an investment that's outside of a retirement plan, which can be another 1% because of the way that they turn over the mutual fund in an attempt. Well, why do they turn over the mutual fund so much? They're attempting to outperform the market. And a little bit like somebody running with a parachute on, the harder you run while wearing the parachute, the higher the resistance gets. We know the more they trade, the more they increase trading costs. And in this case, that trading cost is 1.44, but the taxability of it can drag the returns by an extra percent. So if you had that mutual fund that you looked at and had 0.9% expense ratio, you might be paying 3.17% all in. And if it's in a non-qualified account, it might be 4% of cost a year. Now, if what you're hoping to get is an 8% rate of return year over year, that's a lot of drag to have to overcome. Now, it reminds me of a story of these 2 guys that are kind of from the backwoods. They had grown up and never really had much in the way of education. And these 2 cousins who lived in the country, lived together, had a pickup truck, and one of them went to community college. And he took a class on marketing. And he said, I have got the idea. Cletus, what we're going to do is we are going to buy a bunch of tomatoes and we are going to head to the farmer's market. And they said, oh, my goodness, what are we going to do there? He says, well, we're going to buy a bunch of these tomatoes for $1 each. We're going to drive them over to the farmer's market, sell them for $2 each. Now, that sounds like a pretty good idea. So they load up their pickup truck with a flat of tomatoes covering the bottom of the pickup truck, go to the farmer's market, sold them all. And he says, what are we going to do next week? And he says, I learned in my marketing class what we're going to do is we're going to load up a truckload with twice as many. And he says, we're just going to sell them for $1.50. He says, well, how are we going to make any money if we're only charging 50 cents? Before we were charging $2, they sold just fine. He says, we're going to make it up on volume. So Cletus says, all right, we'll do it. Sure enough, twice as many tomatoes went to farmer's market, sold them all. Cletus thinks his cousin's a genius now. And he says, what are we going to do next weekend? He says, we're going to get twice as many again, sell them for $1.25. Cletus says, you sure? He says, yep, we're going to do it, and it's going to work because we've dropped the price again. So sure enough, they go, sold all their tomatoes. And then the next weekend, goes to Cletus and says, here's what we're going to do. We're going to buy another double amount of tomatoes. And this time, we are going to sell them like crazy because we're going to sell them for 90 cents each. Cletus says, how in the world are we going to make money if we sell them for less than what we paid for them? And he says, keep in mind, I've been taking this marketing class. We're just going to make it up on volume. Now, that we know that you can't make it up on volume when you're losing money with each transaction. And yet, that tends to be what happens when active managers find themselves behind the 8 ball as it relates to returns, is they're attempting to trade more to outperform the market a little bit, like Cletus and his cousin trying to sell tomatoes. Hey everyone, thanks for watching. Be sure to subscribe, ring that bell, and when you get a moment, pick up my book on Amazon, Sound Financial Advice. It's the kind of book that's easy to read, but hard to forget all the knowledge you learned.